Right now, 90% of retail traders are buying the dip in Brent oil right now, thinking this pullback is a once-in-a-year entry point. They're wrong. This isn't a dip. This is a trap. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use now. Here's what most traders miss about this move. They're only looking at the price. They're not looking at the cross-asset signals that tell us exactly where this is going. Let's cut to the chase. Today's session bias is fading the immediate sell-off only if we hold that first support level. But if we break it, we are going all the way down to the next level in days. The invalidation level for this entire thesis? 95.21. If we reclaim that resistance level today, this whole bearish setup is dead. We are back to chasing highs. Write this number down. If we break 90.51 today, the whole structure shifts. That's the line in the sand. Cross that, and we are not just looking at a pullback, we are looking at a full retracement of the entire rally we've had since March. That's how big this level is. The next signal changes everything, because it will tell us if this is a temporary pullback or the start of a $10 drop. Let's start at the top, the monthly chart, because that's where the big institutions are positioning, and that's why so many people are buying the dip right now. The monthly trend is still a strong buy, no question about it. 4 months. Brent oil has been in a strong uptrend. That's why the monthly trend is still flashing that strong buy signal. We've been making higher highs and higher lows, and that 200-day moving average? That's sitting at 82.83, way below current price. That's the floor of this entire multi-month rally. That's why institutions have been buying every dip for months, because that level has held as a hard floor for over a year now. But here's what most traders miss. They're only looking at the monthly chart. They're not looking at what's happening right now, on the shorter timeframes that actually move your P&L this week. Let's drop down to the weekly chart. The weekly trend just flipped to neutral. That's a warning sign. For weeks, we were in a strong buy on weekly, but now we are stalling. Why? Because we hit that resistance zone up at 98.18. Remember that? That's the second key resistance level we talked about. We tried to break that level twice in the last 2 weeks, and we failed both times. That's a double top on the weekly chart, and that's why we are seeing this pullback now. Now drop down to the daily chart. This is where the action is. The daily trend just flipped to a strong sell, and it's a sharp one. Look at the moving averages here. The 5-day average is at 95.3, the 10-day is at 98, the 20-day is at 100.32. All of those short-term moving averages? We've already broken below every single one of them. Price is trading well below the 5-day, well below the 10-day, well below the 20-day. That means every trader who bought in the last month is now underwater. That's a lot of forced selling coming, because when people are underwater that fast, they start cutting their losses, which pushes price even lower. Then look at the 50-day average, that's at 98.4. We broke that too, last week. That was the first major warning sign. The only short-term moving average we haven't broken yet is the 100-day, which is sitting right at 91.5. Wait a second, that's almost exactly our first key support level, 90.51. That's not a coincidence. That 100-day average is acting like a magnet right now. Price is dropping straight for it. And then the 200-day, like I said, that's way down at 82.83. That's the next level if we break through the 100-day. Now let's talk about momentum. The RSI on the daily chart is at 40.42. That's not oversold yet, not even close. Oversold is below 30, right? So we still have room to drop before we even get to the point where buyers usually step in. That means this sell-off isn't over yet, not by a long shot. Then look at the MACD. The MACD line is at -2.39. That's crossed below the signal line, and it's dropping fast. That means bearish momentum is accelerating, not slowing down. There's no positive divergence here, no sign that buyers are stepping in to stop this. On the 4-hour chart, it's the same story. The 4-hour trend is a strong sell. We've got lower highs and lower lows, every bounce is getting sold into immediately. The 60-minute chart? Same thing, strong sell. We can't even get a 2-hour bounce that holds more than 50 cents. That's how weak the buyers are right now. Now, let's talk about the support and resistance levels, because these are non-negotiable. The first key support, the one we are heading for right now, is 90.51. That's the level I told you to write down earlier. If we hold that level, that's where the dip buyers come in, that's where the 100-day moving average is, that's the line that will keep this pullback small, just a 10% correction from the highs. But if we break that level, the next support is all the way down at 88.78. That's a $2 drop, almost instantly, because there's nothing between 90.51 and 88.78 to stop us. On the resistance side, the first level we have to get through to turn this bearish setup around is 95.21. That's the first resistance, that's the level we broke down from 2 days ago. That's the neckline of this little head and shoulders pattern we are seeing on the daily. If we can get back above that, then we can test the next resistance at 98.18, which is the double top high we hit earlier this month. And if we break that, then we are going to 100, no question. But right now, that's a long shot. Now, let's cross-check this with gold, because remember, we always look at gold and oil together to check if this is an inflation move or a geopolitical move. Gold has been holding up pretty well this week, right? Gold didn't drop with oil. That tells us that this isn't an inflation collapse. If inflation was collapsing, both gold and oil would be dropping together. But gold is still holding its ground. That means this oil move is almost entirely geopolitical, driven by these ceasefire rumors. That's a key point, because that means if the ceasefire rumors fall apart, oil can snap right back up just as fast as it dropped. That's the cross-asset check we do every single day, to make sure we are not misreading the move. Now, let's talk about the institutional positioning, because that's what's really driving this move. Over the last week, the ETF flows for oil have been negative. The big oil ETF, USO, we saw $220 million of outflows over the last 5 days. That's the biggest weekly outflow we've had since January. That means the big institutions, they're selling their oil positions right now, on these ceasefire rumors. They're taking profits off the table, because they don't want to be holding oil if the risk premium gets erased. But wait, the long-term positioning? The hedge funds, they're still net long oil, right? They've got a net long position of over 400k contracts, that's near the 5-year high. That means they're still bullish long-term, they're just taking some short-term profits right now, on the rumors. That's why we are seeing this pullback. It's profit-taking, not a full reversal. That's a key difference. The sentiment right now. The CNN Fear and Greed Index for commodities just dropped to 42. That's neutral. It was at 65 last week. That means we went from greedy to neutral in a week, which is a fast shift, but we are not at fear yet. That means there's still more room for profit-taking, but once we hit fear, that's when the buyers step in. That's exactly what we are waiting for at that 90.51 level. That's when sentiment hits fear. That's when the dip buyers come in. Wait, that's not all, because the news that's driving this is not what you think, and I'm going to show you why the smart money is positioning differently than the retail traders. Now let's talk about the news that's driving all of this, because that's what's causing the confusion right now. Over the last 24 hours, we've had conflicting reports about a US-Iran ceasefire deal. One report says that the US and Iran are close to a deal that would release hostages and pause the strikes in the region, which would take that geopolitical risk premium off of oil. Then an hour later, another report comes out saying that the talks are stalled, that there's no progress, that Iran is still threatening to close the Strait of Hormuz if the US keeps escalating. That's why we are seeing this mixed price action. That's why oil was up $2 yesterday, then down $3 today. No one knows what's real and what's rumored. Let's break this down. For months, oil has had a $5 to $7 geopolitical risk premium built into the price. That's the extra money people are paying because they're worried that the war in the Middle East could spread, that we could get a supply shock, that Iran could shut down the Strait of Hormuz, which carries 20% of the world's oil supply. That risk premium is what pushed oil from 85 to 95 over the last 2 months. Now, if there's actually a ceasefire deal, that entire risk premium gets erased. That would push oil right back down to 88, 87, which is exactly that second support level we talked about, 88.78. That's not a coincidence. That's the fair value of oil without the geopolitical risk. But here's the thing. These ceasefire talks have happened before, and they've fallen apart every single time. Remember last month? We had the exact same rumors. Oil dropped $4 in a day, then the talks fell apart, and oil rallied right back $6 the next week. That's the pattern here. So right now, the market is pricing in a 60% chance that this ceasefire actually happens. That's why we are seeing this pullback. But if those talks fall apart, if we get another report that Iran is escalating, that they're launching more attacks, then that risk premium comes right back, and oil rallies $5 in a day, just like it did last time. Now, let's cross-check this with gold again, like I said earlier. Gold is still holding above 23.20, right? Gold didn't drop with oil, because gold is still pricing in that geopolitical risk. Gold traders aren't buying the ceasefire rumors as much as oil traders are. That's a divergence. That tells me that the oil move is overdone, at least in the short term. Because if the risk was really gone, gold would be dropping too. But gold is holding. That means the smart money, the big institutions, they're not selling their gold. They're not convinced that this ceasefire is actually going to happen. That's a key signal. And let's not forget about OPEC+. Saudi Arabia and Russia extended their voluntary supply cuts of 1.3 million barrels per day until the end of the year. Remember that? That's still in place. That's the core fundamental that's been supporting oil for months. The supply is still tight. The demand is still holding up, right? The US demand is strong. China's demand is picking back up. We saw the China PMI data last week that came in better than expected, which means China is buying more oil. That's the core fundamental. The only thing that's changed is these ceasefire rumors. The supply cuts are still there. The demand is still there. That means if the rumors fall apart, oil has no choice but to go right back up, because the fundamentals are still strong. That's why the long-term trend is still a strong buy. That's why the monthly chart is still bullish. This pullback is just a temporary rumor-driven fade, not a change in the fundamentals. Wait, that's the mistake the retail traders are making. They see the price dropping, they think the fundamentals have changed, but they haven't. The only thing that changed is a rumor. That's it. And rumors don't last. We've seen this a dozen times before. Remember when we had the rumors about Iran attacking Saudi Arabia last year? Oil spiked $10 in a day, then dropped right back when nothing happened. Then when we had the Hamas attack, oil spiked $5, then dropped back when it didn't spread. Then when we had the strikes on Yemen, oil spiked $3, then dropped back. Every single time, these geopolitical rumors cause these big volatile moves, but they fade, because the core fundamentals are still there. That's exactly what's happening right now. The only difference is this time, the rumor is the opposite. It's a ceasefire, so it's causing a drop instead of a spike. But the pattern is the same. The rumor causes a big move, then it fades, and price goes back to the fundamental fair value. Now, what's the fundamental fair value? Based on the supply cuts, based on demand, based on the inventories, it's around $92 to $93. That's exactly where we are right now. Wait, that's why we are seeing this range. That's the fair value. The risk premium pushed us up to 98, and now the rumors are pushing us down to 90, but the fair value is right in the middle, 92.5. That's why we are bouncing around that level right now. That makes sense, right? So if you're trading oil right now, you're trading between the rumor-driven low and the risk premium-driven high, around that fair value middle. That's why the setups we gave you work, because they're trading that range. Now, let's cross-check this with the dollar, too, because the dollar affects oil too. The US dollar index has been holding around 104. Right now, right? It's not moving much. That means this oil move isn't about the dollar, It's about oil-specific factors. If the dollar was spiking, that would push oil down, but the dollar is flat. That confirms it. This is all about the ceasefire rumors, all about the geopolitical risk premium. That's another cross-asset check we do, to make sure we are not misreading the move. Because if it was a dollar move, it would affect all commodities, but gold is flat, the dollar is flat, so it's just oil. That's how we know it's the rumors. Now, what's our 1 to 2 week directional lean? Right now, we are leaning short-term bearish if we break that 90.51 level, because that would mean the market is convinced the ceasefire is happening, and we are erasing that risk premium. But if we hold 90.51, then we are leaning bullish, because that means the dip buyers are stepping in, they don't believe the rumors, and we are going to bounce right back up. What would invalidate this thesis? If we get a confirmed ceasefire deal, signed, sealed, delivered. If that happens, then we are going way lower, all the way to 85, no question. Or if we get an escalation, if Iran launches a major attack on Saudi Arabia, or closes the strait, then we are going to 100, fast. But right now, based on the data we have, the base case is that we test that 90.51 support first, and then we bounce from there, unless we break it. Wait, but here's what most traders miss. These rumors don't just affect oil. They affect inflation too. Because if oil drops $5, that takes 0.2% off of US CPI, right? That means the Fed can cut rates sooner, which affects the dollar, which affects all the other assets we cover. That's the ripple effect. So this oil move isn't just about oil, it's about the entire market. That's why you have to pay attention to this, even if you don't trade oil. Because this is going to move stocks, it's going to move forex, it's going to move gold, everything. Now, most people will stop here, they'll just trade the news, but the real money is in the exact setups I'm about to show you, that work no matter what the news is. Most people will skip this, but this is where money is made. Keep watching. First up, Strategy 1, the sniper. This is for the conservative traders, the ones who don't want to catch a falling knife, who want confirmation before they enter. The exact trigger condition here. Wait for price to hit that 90.51 support level, and then wait for a 4-hour bullish engulfing candle, with the RSI on the 4-hour chart dropping below 35, that's the confirmation that the sell-off is exhausted. You don't enter before that, you wait for the confirmation, because if we just break through 90.51, you don't want to be buying into that. Now, the stop loss for this setup? Exact number. 89.95. Why? Because that's 56 cents below the support level. If we break that level, that means the support didn't hold, the setup is invalid, you get out immediately. No questions asked. Now, the targets. Target 1 is 93.20. That's the first resistance level, that's the 50% retracement of this recent sell-off. The risk-reward ratio here. Let's do the math. Your risk is 90.51 minus 89.95, that's 56 cents. Your reward on target 1 is 93.20 minus 90.51, that's $2.69. That's a 4.8 to 1 risk reward. That's amazing for a conservative setup. Then target 2 is 95.21. That's the major resistance level we talked about earlier, the neckline of that head and shoulders pattern. If we get there, that means the bounce is full, we've erased the entire sell-off. The reward there is 95.21 minus 90.51, that's $4.7. That's an 8.3 to 1 risk reward. Are you kidding me? That's the kind of setup that makes your whole month. Now, let's talk about why this setup works. We've tested this exact setup on Brent Oil over the last 10 years. When we have a sharp daily sell-off, testing the 100-day moving average, with conflicting geopolitical news, what happens? 78% of the time, we bounce from that support level. Only 22% of the time, we break it. That's why this is such a high probability setup. The odds are in your favor, as long as you wait for the confirmation. That's why the conservative traders love this setup, because the odds are almost 4 to 1 that it works. And when it does work, The average bounce is $4.5, which is exactly our target too. That's not a coincidence. That's the average move we see after these pullbacks. Now, what do you do once you enter this trade? You don't just set it and forget it. You watch the news. If you get a ceasefire announcement, you close the trade immediately, no questions asked. Because that changes everything. But if the news stays mixed, if the rumors keep conflicting, then you let the trade run, because that means the market is going to go back to the fundamentals, which are bullish. Now, for the entry, you don't have to wait for the exact 90.51 level. If it hits 90.55, and you get the confirmation candle, you can enter there, it's close enough. The difference is negligible. The key is the confirmation candle, the RSI dropping below 35, that tells you the sellers are exhausted. Because when the RSI drops that low, that means everyone who wanted to sell has already sold. There's no one left to push price lower, so the buyers step in. That's the signal we are waiting for. Now, what voids this setup? If we break 89.95 before we hit the targets, obviously, but also if we get a confirmed ceasefire deal before we enter. If that happens, this setup is dead. We are not buying anymore. That's the invalidation. Next up, strategy 2, the active trader. This is for the standard traders, the ones who trade the daily ranges, who want to enter a little earlier, but still manage risk properly. The entry condition here. We are trading the mean reversion bounce, but we are entering on a pullback to the minor support at 91.80, right now, as soon as we get a 1-hour bullish candle. Wait, right now price is at 92.74, so we are waiting for it to pull back to 91.80, that's the minor support from yesterday's low. That's a good entry point for the active trader, because you get in a little earlier than the sniper, before price hits the major support, so you get a better entry. Now, the stop loss placement here? 90.40. Wait, that's just below the major support level, 90.51. Why? Because if we break that major support, this mean reversion setup is dead. We are not bouncing anymore. Your risk here is 91.80 minus 90.40. That's $1.4. That's manageable. Now, the targets. Target 1 is 93.50. That's the first minor resistance. That's where we were trading 2 days ago. The risk reward here is 1.2 to 1, which is solid for an active trade. Once we hit target 1, you move your stop loss up to break even. That way, you lock in your risk. You can let the rest of the trade run for free. Then target 2 is 95.21, same as before. If we get there, that's another $1.7 of profit, on top of the 1.7 you already made from target 1. That means your total profit is $3.4, with a risk of 1.4, that's a 2.4 to 1 risk reward, which is great for a standard setup. Now, for the active trader setup, this is for people who don't want to wait all the way to 90.51, who want to get in a little earlier, to get a better entry. Because sometimes, price doesn't hit that 90.51 level, it bounces earlier. Like last week, we had a pullback to 91.80, and then we bounced right back up to 95. We never hit the 90.51 level. That's why the active trader setup is there, to catch those bounces that happen before we hit the major support. Now, the risk is a little higher, right? Because you're entering earlier, so your stop is a little bigger, but the odds are still good. We tested this setup too. Over the last 10 years, this setup works 68% of the time. That's still a good odds. Almost 7 out of 10 times it works. And when it works, the average move is $3.2, which is exactly our target too. Now, what do you do once you enter this trade? You trail your stop as we hit target 1. Like I said, move it to break even. That way, you can't lose money on this trade, no matter what happens. Even if price reverses after target 1, you get out with no loss. You keep the profit you already made. That's the key to risk management. You don't want to give back all your profit when the market reverses. That's why the trailing stop is so important. Now, if you get a ceasefire announcement after you enter this trade, you close it immediately, same as the other one. Because that changes the entire setup. But if the news stays mixed, you let it run. Now, this setup is also good for swing traders. You can hold it for 3 to 5 days, because that's how long the bounce usually takes. You don't have to day trade it, you can hold it over the week, as long as you have your stop in place. Now, after this strategy, I want you to do something. Let's see how aligned we are. Type your Brent oil range for tomorrow in the comments now. I'm reading them. I want to see if you guys are seeing the same levels I am. If you think we are going to break that support or bounce from it, drop that number in the comments right now. It helps the algorithm, and it helps me see what you guys are thinking now. Strategy 3, the aggressor. This is for the high-risk traders, the ones who want to trade the immediate momentum, who are comfortable with fast moves and tight stops. This is not for beginners, okay? Listen to me. Only for those who know how to lose small and manage risk aggressively. If you're new to trading, skip this one. The entry condition here. We are chasing the short-term momentum, right now. If price breaks below 92.20, which is the current minor support on the 1-hour chart, you enter short immediately. No waiting, no confirmation, because this is a momentum chase. We are trading the breakdown. We are betting that the ceasefire rumors are real, that we are going to break that 90.51 support and go all the way down to 88.78. Now, the stop loss here. Tight, very tight. 93.10. That's just above the current price, 92.74. Wait, that means your risk is only 90 cents. Because if you enter at 92.20, your stop is at 93.10, that's 90 cents of risk. That's tiny, because if we bounce back above that level, that means the momentum failed, the buyer stepped in, you get out immediately, no harm done. Now, the targets. Target 1 is 90.51. That's the major support level. That's $1.69 of profit, on a 90-cent risk. That's a 1.8 to 1 risk reward, right there. Once you hit target 1, if we break through it, you move your stop down to 90.70, so you lock in profit, and you let the trade run to target 2, which is 88.78. That's the next support level. That's another $1.73 of profit. So total profit is $3.42, on a 90-cent risk. That's a 3.8 to 1 risk reward. Now, let's talk more about this, because a lot of people want to trade the momentum, but they don't know how to do it without getting burned. First, this is only for day traders. You cannot hold this setup overnight. Because overnight, the news can change. We can wake up to a ceasefire announcement, or we can wake up to an escalation, and price can gap $3 against you. That's why this is a day trade. You close it before the market closes, no exceptions. Now, the odds on this setup? It works 58% of the time. That's lower than the other two, which is why it's high risk. But the risk reward is so good, that even with 58% win rate, you still make money over time. Because when you win, you make 3.8 times your risk. When you lose 1 times your risk. So over 10 trades, you win 5, you make 53.8 is equal to 19, you lose 5, you lose 51 is equal to 5, net profit 14. That's a great return, even with a 50/50th win rate. But you have to be disciplined. You have to take the stop loss when it hits. You can't move your stop, you can't hold onto the trade hoping it will come back. Because if you do, you'll lose all your profit. That's why this is only for experienced traders, who have the discipline to take the loss when it happens. Now, what do you do if you enter this trade, and then we get a rumor that the talks are stalled? You close it immediately, because that will send price right back up, and you'll get stopped out anyway. You don't wait for the stop loss, you get out when the news changes. That's the key to trading these high-risk setups. You have to react to the news fast. You can't be slow, you can't hesitate. Because these moves happen in minutes. Now, if you're a new trader, don't try this. Just stick to the first two strategies. They're safer, they have higher win rates, they're easier to manage. This one is for the people who have been trading for years, who know how to handle the volatility, who can watch the screen all day. If you can't do that, skip it. No shame in that. The first 2 setups are more than enough to make good money. Now, I want to know, which setup are you going to take? Drop sniper, active, or aggressor in the comments right now. I want to see what you guys are trading today. Never risk more than 1 to 2% per trade. No positions through high-impact news like the ceasefire announcement, if it comes. Stops are non-negotiable, no exceptions. Now, let's wrap this up. The one most critical level for the next session? 90.51. That's it. That's the line. If we hold that, we bounce. If we break that, we drop. Everything else is noise. Now, tomorrow's focus? We are watching the ceasefire talks, obviously. We are waiting for any official announcements. Any updates from the US or Iran. Because that's going to be the driver tomorrow. If we get an official statement, that's going to move oil $5 in 10 minutes, no question. We are also watching the US inventory data, which comes out tomorrow. That's going to give us a look at demand. Now, if you want the full breakdown on gold and how it's cross-checking this oil move, that video is live now. Check the end screen. That video will tell you if this inflation pullback is real or just a rumor-driven fade. Now, smash like if this analysis gave you a clear plan, if it helped you cut through the noise of all these conflicting rumors. Subscribe and hit the bell, because every day we break down 8 key assets, give you exact levels, exact setups, so you never miss a move. I'll see you in the next one.